Hi, I'm Zachary Hunter. Welcome to the Explain to Me podcast. EITM Pod is about info without gatekeeping, encouraging curiosity, community, and education without drowning in jargon. Today, I wanted to get away from pop culture videos and get back to the personal finance topic that was my first real video on this channel. As some of you may know, I'm an attorney and certified financial planner. And while this is not specific/personal financial advice, just educational content, I think this might help give you some necessary basics about an important and aspirational topic. So, what is the question today? What is home ownership? I'm going to try to answer this question using the classic who, what, where, when, why, and how questions. Except I don't know your situation, so the when and where is largely going to be based on your situation, circumstances, and geography. That being said, let's start. First, who? Who buys homes? Well, let's start with the United States of America. In this country, around 66% of Americans own a home, but that ranges from 80% for those in their early 70s, down to less than 24% for adults 25 and under. The older you are, the higher chance you own a home. But contrary to what social media and the doom and gloom on there says, millennials and even Gen Z do own homes in large numbers, just not quite/yet at the levels older Americans currently or historically do/did. Worldwide, that overall amount ranges from the People's Republic of China, 96% of homeownership, down to 25% for Nigeria. And their numbers might be even less for some other countries, but I couldn't find data for them. Age-wise, the average first-time home buyer in the United States is around 35 years old, according to the National Association of Realtors. Obviously, not a source that is going to be encouraging or even fair to the idea of renting over buying, even in the most transient or most unsettled parts of your life, such as your early 20s. But it is one that one would assume at least collects accurate data on the customers that they're on its customers while charging their hefty fees. Speaking about that, realtors and real estate agents are a community of people whose job it is to find houses/apartments/condos for folks looking to buy. And then they go back and forth with each other to help steer the negotiation so the buyer/seller, depending on which side they're on, gets the best available terms and that the realtor earns their commission, which is usually a percentage of the purchase price. It is in the realtor's interest to have the home sell at the highest price the buyer is willing to pay. So the realtors can get the largest commission possible. Like with financial advisors, as I mentioned in that previous video, I am against people taking a percentage of our money when they do not have our best interests in mind when they do not have a fiduciary duty to serve us instead of themselves. Next, what? Whether by condo, aka when you own your apartment and you pay a fee for some utilities and communal areas like the pool with your neighbors, a co-op, when you own a share in a company that owns and runs the apartment, with each share basically the right to a specific apartment. Or in what lawyers call ownership in fee simple, FEE simple. aka it is yours to buy, sell, and do with however you want, as long as you don't break any other laws. Do any of those, and you are a homeowner the moment you get those keys, which I'll get to when we talk about closing. Also, I should add that if you're married and you're in about half of the United States that have what's called tenancy by the entirety, the marriage is the owner technically of the home, which helps a lot because basically it means that if they're a gambler, your husband/wife isn't going to be able to bet the house on the ponies, at least not with your consent. It is one of the many economic benefits of marriage. I'll get into more of those when I do my What is Marriage video that I have planned. But for now, what about if you are one of the almost every person who cannot buy a home in cash or does not get one from a dead relative? More on that later. Well, then, you will get a home loan, usually called a mortgage. In many states, you still own or have title to your property, and the loan is what's called a lien against it. LIEN. Basically, it's something that needs to be paid off before you sell it yourself, things like that. But in some places, it works. A mortgage works more like a car loan, and you get the title/deed once you pay the bank back. And as for the mortgage itself, 15 and 30 years until it's fully repaid back is the typical length here in the United States. Other countries have different ones, 20 years, things like that. You pay once a month, and that monthly payment is made up of interest, which is pre-baked into the loan through what's called amortization, AMORTIZATION, principal, aka what you actually borrowed, and possibly 3, what's called purchase money insurance, or PMI. And whether you pay any PMI largely depends on how much you put down. 20% down is usually what it's required to get you out of it. It depends on the loan. Also, when you took out the loan. But basically, it's whether or not the amount you owe is less than 80% of what the home is worth. Now, you could pay more than the minimum in a given month, those 3 parts, or 2 if you don't have PMI. And the extra does not go to the interest. Instead, it goes back to the principal of what you actually owe. And that means you pay off the loan faster. Basically, if you pay the equivalent of 13 months worth each year instead of the 12 times, that 30-year mortgage would be paid off in 24 years, or 312 payments instead of the standard 360. Thus, saving potentially tens or even hundreds of thousands of dollars because you're paying less in interest. Now, next question, why? The why of homeownership isn't an easy question. I'm not sure it ever was, but for years, people would say all sorts of romantic things about homeownership. They would say it's a key part of the so-called American dream. Others would point out how the interest you pay on that mortgage, which if you stick to the 15 or 30-year time frame, is again front-loaded in the loan such that through that amortization that I mentioned earlier, that it would be tax deductible should you itemize on your federal income tax. Unfortunately, half of all mortgages that are currently out there are low interest, so 4% or less, well below the rates new loans would be at, 6 or more. And until at least the end of 2025, the standard deduction, the one you get when you don't itemize, just the typical when you file your taxes amount, it is so large that only about 1 in 10 American taxpayers itemizes their deductions. It used to be about a third did. This change with the higher standard deduction also is the reason why most people do not get any tax break anymore for giving to charity in a given year. Also, under the so-called Trump tax cuts, the TCJA, the Tax Cuts and Jobs Act, a lot of the tax bill homeowners pay, which is typically property tax, on those homes doesn't get a federal tax break anymore. Because now only the first $10,000 state and local taxes, that's income, state, that's income, sales, or property taxes, can count as a deduction on your IRS or federal bill. And if you're in a high tax state such as California or New York, you hit that 10,000 real fast, and that's all you have. You don't get the tax break from the property taxes that you normally would beforehand. So basically, the most commonly cited tax benefits of homeownership do not currently apply to most folks. Plus, the cost of owning a home is much higher. The affordability is at an all-time low. I say the most common tax benefits, though, as there are two that are likely a lot bigger. But most people don't think about these as tax benefits. First, there's the fact that by living in your own home, your house is essentially tax-free income. Because the owner of the property, the landlord, if you want to use that term, isn't charging quote-unquote you rent. So given what a comparable hotel room or Airbnb or Vrbo would cost, that is a lot of quote-unquote free income that you are paying yourself. This idea of the income connection to your home is also related to how you can unlock the full power of the home office deduction if you're self-employed. And second, there are huge tax breaks for when you go to sell your home. So let's give an example of, let's say you live in your home for 2 of the last 5 years. And from the time you bought it, whenever that may have been, it grows in value. So much so that when you go to sell it, you would normally be on the hook for the increase, which means you're on the hook for capital gains taxes, in addition to any transfer tax and fees that you may pay regardless of price. But if you've lived 2 of the last 5 years in your home, $250,000, or if you're married, $500,000 of that increase in value would be tax-free. Excluded is the term. Now, for most folks, that means most or even all of the tax bill from selling your home vanishes. Especially if you are a married couple who decides to move, downsize, or whatever. But wait, there's an even better benefit, tax-wise. And the only downside is that somebody has to die. Basically, if you have a parent, grandparent, whatever, and they leave you a house, for tax purposes, instead of a percentage of what it sells for, minus what they paid for it, cost minus basis, to use that terminology, it becomes minus what it is worth when they die. So let me give you an example. Let's say single mom Sally buys a home for $100,000. And when she dies, it is worth $600,000. The house goes to her only child, Richie, who immediately turns around and sells it. Now, if Sally had sold the house on the day she died, obviously before she died, that $500K in gain would have $250,000 not counted as excluded, as she lives there, and that remaining $250,000 would likely be taxed at about 15%, or $37,000 in tax going to the IRS, and about $462,000 in gain/profit. Now, if Richie sells it the day after she dies and leaves it to him, its basis, aka what gets subtracted from the sales price, to figure out the capital gain, is now $600,000. 600 minus 600 is 0. So Richie, assuming no inheritance tax or fees and commission from realtors, etc., might get $600,000 free and clear. That's $37,000 in taxes he doesn't have to pay, and the original $100K in purchase price passed on tax-free from Sally to her son Richie, in addition to the profit/appreciation of the home. Now let's compare that to the day before she dies. She gives the house to Richie. Well, she can only give what she owns. That basis is what she puts in. So if that basis is still only $100,000 and the house is now worth $600,000, if the day after she dies he sells it, that means it's at the very least going to be $500,000 in gain, which means that tax bill gets way bigger, way faster. But this 37 grand in taxes not having to be paid, even more if you consider the idea of if it was a gift instead of inheritance, it's not too shabby. So now let's get into the how of home ownership. So the main difference between buying a house and purchasing the most expensive loaf of bread in the world is the mortgage. Banks, typically after running your credit and making you answer all sorts of questions about your income, your life, where you've lived, you see how likely you are to be unable to pay them back, how much of a credit risk you are. Once your real estate agent seemingly gets their commission's worth, negotiating with the buyer's agent, the bank will go through the what's called due diligence on the loan. And depending on whether you, as a buyer, are pre-approved to borrow up to a certain dollar amount, how much you plan to put down on the home, the 20% to avoid PMI or a different amount depending on the nature of the loan, and the type of loan itself that you are taking, such as FHA, Federal Home Agency, VA, Veterans Affairs, physician loans, or a conventional mortgage, and also your credit history / income sources. So if you have money under your mattress, you have to explain it. You might have to answer a lot of questions and provide a lot of documentation. But once that's all settled, and once the bank approves it, you'll have what's called your closing, which is the time most folks sign their name more times than ever before in their life. And after all of these signatures, you and the sellers and the notarizations, you hand over a very large cashier's check for the down payment plus fees, aka closing costs. And in exchange, the seller gives you their keys. And then suddenly, you have a house and a mortgage. Then about a month later, you'll start paying your mortgage each month. In the meantime, you'll be enjoying all the pluses and minuses of homeownership. You no longer have a landlord, which means if your water heater or water pipes break, it's on you. So you better make sure you have things like homeowner's insurance and money in the bank to cover the repairs. I'm not even counting renovations. This is just keeping the lights on. Rule of thumb for repairs, utilities, the so-called phantom costs of homeownership are mortgage payment plus 50%. And if that mortgage plus 50% is more than 28% of your gross pay / salary, you can just say 30% if it's easier to do the math. It probably makes sense for you to rent right now, not buy. Again, this isn't financial advice. I'm just a certified financial planner who is letting you know what I understand about this topic and using the rules of thumb that they tell us when you study for those exams. And that's about that. I didn't want this video or this episode to drown you in too much details about architectural improvements or utility questions or appliances like gas versus induction stoves and the like. There are other places to find out that information. Instead, I wanted to just give you a nice, quick summary of what is going on when you try to buy a house. So I hope you liked this video. And if you did, or if you just want to do me a favor, could you please like, rate, and subscribe on whatever format you're getting this show to help me grow EITM. And if you could, tell your friends about it. Also, if you have any questions or better yet suggestions for future topics, I can be reached at eitmpod@gmail.com, eitmpod@gmail.com. And I have to ask, if you are willing to help the show monetarily, you now have the option of you can use Buy Me a Coffee or Ko-fi.com. You can do either of those. It's under EITM POD, EITM Pod at both. I have links to the description. Any help would be appreciated, but either way, please continue to watch and listen. And until next time, please stay safe out there. God bless. Thanks for your time.